Now we're going to cover one important aspect which you as a project manager should always be aware of, that is capital expenditure versus operating expenditure. Before we go in depth of how these two are important for you as a project manager, how you plan for your various expenses based on understanding of the capital expenditure and the operating expenditure, let's look at what is precisely meant by capital expenditure, what is precisely meant by operating expenditure. First, let's understand the term capital expenditure. The capital expenditure is that expenditure which results in purchase of a new fixed asset, procurement of a new fixed asset. Now that can be anything. It can be a new factory, land, building, machinery, anything which involves a huge investment on the part of the company of resources. It can also be any expenditure which is carried out by way of repair, which does either of the three things to that asset which is being repaired. It either makes it bigger, better, or longer. Now by these three analogy, we mean that is it making the asset bigger in size, thereby increasing its production facility, enhancing its features and such stuff, then yes, it is a capital expenditure. Is it making it better? Suppose by incurring this expenditure, let's say of about $100,000, your factory is now going to be able to produce 1,000 units extra per hour based on the previous output. So that is making the asset better in efficiency. So that is a capital expenditure. Is it making the asset longer? That is it extending the useful life of the asset by incurring that expenditure? If yes, then it is a capital expenditure. If the asset does not result in, if the expense, which is kind of a repair, does not result in the asset becoming a bigger, better, or a longer version of its existing version, then it's not a capital expenditure. It is just an operating expenditure. Also, if the expense results in procurement or purchase of a new asset, yes, it is a capital expenditure. So that is a criteria for understanding an expense, whether an expense is a capital expenditure or not. Okay. The other expenditure is the operating expenditure. Now the expenditure which is incurred to ensure the day-to-day operations are carried out smoothly are known as operating expenditure. To put it in other words, any expenditure which is not a capital expenditure can be termed as an operating expenditure. Now that can be your purchase of the goods from the creditors on a day-to-day basis, paying of the factory rent, utilities, repairs and maintenance of the existing machinery to ensure smooth functionality, but it does not make the asset any bigger, any better, any longer. It just keeps on the existing machinery, existing asset functions smoothly. That's it. So that is an operating expenditure. So with this, I hope you have an understanding of what is meant by capital expenditure and what is meant by operating expenditure. Capital expenditure involves a huge outflow of cash certain point of times, right? Understand this thing importantly. We'll look at another important concept based on this understanding, what is buying versus leasing. Now, whenever you buy a new asset, that is a capital expenditure. Whenever you lease an asset, you lease a machinery, equipment, and certain on which you just need to pay a monthly rent or monthly lease fees, that is an operating expenditure. So buying versus leasing is basically your capex versus opex. If you're wondering what's the importance of this thing in a project manager, as a project manager, hold on to your seats. We're going to jump into depth of it right now. Now let's say you need to purchase a big machinery to successfully complete your existing project in hand. For procuring that big machinery, obviously it's going to involve a huge outflow of cash. Might be the machinery cost around $1 million, another additional 10-20,000 for transportation, installation, and stuff like that. And there's another company who is financing the same machineries for a year-to-year basis based on a lease fee of say $20,000, $30,000 a month. Now, which is a better option for you as a project manager to ask your company to allocate to you? Is it buying a new machinery for you or is it leasing the new machinery for you? We'll understand this thing with the help of an example over here, which will help us understanding it in a better way. Now let's say we're going to do an analysis of capex versus opex. Okay, that is buying versus leasing. Okay, yeah. So here we're going to list out the line items. Here we say the company incurs an expense, a capex expense, and here we say the company incurs an opex expense. That is, they buy the machinery over here. What is the scenario if we buy it, and if we lease it, what is the scenario over here, right? So cost of the asset, it's $1 million, right? We'll continue with the same example which we had just used for the theory part. That will enable us for easy understanding. $1 million for the machinery. sorry, that meant to 10 million. That's it, $1 million. Cost of the asset for an OPEX is going to be zero, nil dollars, right? Because you're not buying the machinery, you're just going to lease it out. Now, cost of transporting the asset is supposedly another $10,000. It's a heavy machinery, gonna get it from the factory to the site. Let's say in case of lease also, the lessor is not that much lenient with the money, so he asks you to bear the expense if you want the asset delivered to your premises, and you need to do that because it's a heavy machinery which is required for the project. Over here, you also incur in $10,000 of expense for getting the machine to premises. Annual lease at the rate of, let's say, $20,000 a month, dollars per month. So it's going to be $20,000 multiplied by 12. That's going to be $240,000. And let's say a security deposit refundable, which is refundable security deposit. It's supposed to be, let's say, around another $100,000. Okay. Over here, the sale value. Okay, wait. We'll put the sale value of the machinery over here, of the asset at the end of 3 years. Might be we charge a depreciation of somewhere around $150,000 a year. So that's going to be $450,000 for 3 years on a straight line basis. We're taking a 15% depreciation. So that leaves the asset with a residual value of, let's say that's going to be equal to $1 million minus, it's going to be depreciation of $450,000. So that leaves the machinery with a value of, at the end of useful life, of $550,000, which is going to be realized. So here we're going to understand this thing, that this is the outflow of the amounts. Okay, you have to incur these amounts to get the machine delivered to your premises. So looking at the scenario over here, if we take it for a first year of total annual cash outflow for first year, we're going to have cost of the asset to be incurred if we buy the asset, and cost of transporting the asset. We don't consider the sale value as of now because that's going to be realized at the end of the third year, and we're just considering the factors for the end of the first year. Okay, that's why we have ignored this figure for the time being. Now over here we do the same thing. We have to transport the asset to our premises. We're going to pay an annual lease of $240,000, and we have to pay a refundable security deposit of $100,000. Even though this is refundable to us at the end of the third year or fifth year, whenever you're going to complete using the asset, it's still an outflow of cash for the first year, so we're recording it as an outflow. So if you see the difference over here, that's huge, right? $1 million and 10,000 versus $350,000 just to lease the asset. If you are working as a project manager and you have this dilemma whether to buy the machinery itself or to use the lease facility if it's available, this is the competition you need to refer to understand what amount of pressure will it put on your budget as a company, to understand which is the convenient way to use your resources the most efficiently without putting much more resource constraints on your own budget, and utilizing the machinery to the most efficient way, right? This is a simple computation on the reason of using a machinery by way of leasing rather than buying. Now let's see let's see what is the impact at the end of the third year. We see what is the total outflow for 3 years. Okay, so here we're going to have the same outflow of cost of the asset plus cost of transporting the asset, and we're going to receive the value at the end of third year for $550,000, saying under the assumption that we're going to receive the entire value of the machinery. Okay, there's no reduction going to be there. Still we end up incurring an outflow of $460,000 versus over here, if we consider the cost of the asset for this one over here plus $720,000, that is $240,000 into 3. Just make me compute this as 3. Okay, so here we're going to compute $10,000 plus $720,000, and we're going to ignore the security deposit for the time being because we paid at the first year, we receive it back at the end of the third year, so that effect nullifies. So the total outflow which we incur is $730,000. So now you understand that your computations are changing up. Now if you look at the long-term scenario, as a project manager, you need to take up the machinery on a capital basis. Like, you need to buy the machinery. That's going to be realizing you much more. That's going to reduce your outflow over a period of 3 years rather than the leasing of the machinery, right? So that is how you interpret the capex versus opex figures. Okay, buying versus leasing facility for a new asset. And with this, we complete the most important analysis of buying versus leases, capital expenditure versus operating expenditure. There's no standard definition that you need to buy an asset or need to lease an asset, anything. It's entirely upon you to take a rational call based on the understanding till what point of time you're going to use that machinery, till what point of time you're going to sell that machinery, and what is the resale value and stuff like that. Okay, that was all with regard to buying versus leases.